West Texas oil seeing its steepest one-day decline since the depths of COVID in 2020, but that's still about $30 per barrel higher than before the Iran war began. So what are the ripple effects of this shock going to be on the economy and the consumer? Joining me now is Eric Rosengren, former Boston Fed president and currently a visiting scholar at the MIT Golub Center for Finance and Policy. And Erica, it's great to see you. I guess maybe a 6-week shock, disruption here, maybe a stagflationary impulse is not enough to draw conclusions from. But how do you think, as a Fed policymaker, we should be approaching this?
Well, I think the first thing is whether Sarah's right and that it's going to be difficult to get an agreement. So right now we've had 6 weeks of disruption. We still don't have the strait open up for the kind of traffic that we were seeing before the war. So until that actually happens, we're going to continue to have somewhat of a supply shock. And even when things do get normalized at some point, you have to make up for the energy infrastructure that was destroyed in the Middle East between the Gulf states and Iran. So I think the supply shock is likely to be fairly persistent. And it's not just oil, it affects other products as well that are oil-based. We can see things like transportation. Anyone buying a plane ticket to California right now knows it's quite expensive. So I think we're going to be seeing in the next series of CPIs and PCE inflation numbers that the core numbers are staying at 3% or higher. That's a difficult place for the FOMC to be. And I think it's going to be difficult for the committee to lower rates until they are more certain that core inflation is going to be drifting down. And I don't think that'll be until the fall.
Now, even before the conflict, the Fed was basically not at its target necessarily, or was some distance from absolute full employment and obviously some distance from 2% inflation. And therefore, it was in a bit of a wait and see mode already. And the markets didn't expect a rate move for at least a couple of months at that point. How does that change here? I mean, we also did get a relatively strong employment report. It's only 1 month, but it seems like it maybe lessened the downside risks to the economy from the Fed's perspective.
I would agree with that. I think that the downside risk to the economy and employment, based on the last employment report, is probably not as serious. I would highlight, though, that the shock has just recently happened, and it's going to take some time to see how it funnels through the economy. But the inflation impulse, I think, is pretty certain. And if you look back to the March meeting, there were 7 members who didn't want to lower rates at all this year. There were 7 members that only wanted to lower it one time. So already you had a committee that, even before the length of the oil shock was known, was already unsure whether they were going to be cutting at all this year or not. And at least 7 members have been pretty hawkish and actually arguing that they don't see any interest in decreasing rates at all this year. So I think it's going to be difficult to see how you would get a scenario unless the economy weakens significantly from here. And so far, we're not seeing that data.